Red alert doesn't always arrive as a headline. Sometimes it arrives as a quiet change in market posture. The quotes get thinner, the spreads widen, and the people who normally stand in the middle suddenly stop volunteering their balance sheet to keep the game smooth. If you've been watching silver lately, you've probably felt it. Price looks strong, yet the real tension isn't just on the chart. It's in the mechanics that most viewers never see. Financing terms, near-dated settlement preference, and the willingness of major desks to keep making a market when volatility turns from opportunity into liability. Now here, amidst the scenario that has traders whispering going into month end, what if a legacy bullion dealer, one of the names that used to anchor liquidity, decides it's done? Not reducing risk, not restructuring, but stepping away from the obligation to be the shock absorber. That kind of exit is not a normal corporate event. It's a structural event because market making is the invisible service that converts chaos into price discovery. Remove enough of it, and you don't just get higher prices, you get discontinuous prices, gaps, air pockets, and violent squeezes that punish anyone relying on normal liquidity. Now, important disclaimer, you should treat any dramatic claim as unverified unless you can independently confirm it. What matters for us is not gossip, it's the logic chain. If a major market maker withdraws near month end, what happens to a market like silver where paper claims are enormous relative to physical throughput? And that's where it gets uncomfortable, because silver is two markets welded together. A fast, deep paper market where positions can be created instantly, and a slow physical market where inventory has location, lead time, and a real cost to move. Most of the time, the weld holds because participants roll and net rather than demand metal. But in stress windows, the incentive structure shifts. People start caring about immediacy. They start paying up for now, not later. And when now hot becomes valuable, you begin to see the first sign of a shortage that doesn't need the world to run out of silver. It only needs the next available ounce to be harder to source at the exact moment it's required. That's why month-end matters. Month-end compresses time. Time compression forces behavior. Behavior moves markets faster than opinions ever will. So in this video, we are going to do what most coverage refuses to do. We were going to map the mechanics step by step, not to promise a number, not to sell you a fantasy, but to explain the pathways that turn a quiet tightening into a headline move. And if you hold silver, or you're thinking about entering, this matters because the biggest mistake people make in late cycle metals is focusing on a perfect entry while ignoring the possibility that liquidity itself changes overnight. If liquidity changes, you can be right on fundamentals and still get wrecked on timing. You can also be late on price and still be early in regime. That's the real risk-watching reward here. Regime shift, not a candle pattern. Now, let ES start at the center. Why a market maker exit is gasoline on a silver fire. Because once you understand that, all the other signals start to make sense. Market making sounds glamorous, but it's mostly math and pain. A market maker earns the spread, hedges inventory, and funds that inventory through financing markets. They survive when volatility is tradable and predictable. They suffer when volatility becomes one-way and correlated across books, because hedges stop hedging and financing stops cooperating. Regulation matters too, because commodity derivatives consume capital and balance sheet space, and in tight financial conditions, balance sheet becomes the rarest commodity on earth. So when a major institution decides to withdraw from making markets, it's often not because they hate silver. It's because the economics no longer work. Spreads are compressed by electronic trading. Compliance as expensive capital charges rise, and the risk of being stuck short into a physical squeeze becomes existential. Silver amplifies this because it is margin sensitive and liquidity sensitive. Small policy changes in margin requirements can force quick repositioning, and quick repositioning is exactly what destabilizes a market that relies on netting rather than delivery. And here's the key idea. You don't need a default for a squeeze. You only need forced buying on a deadline with insufficient depth. When time boxes appear, optionalities disappear. A participant who has months to adjust can do it quietly. A participant who has weeks has to show their hand in flow, even if they try not to. And flow is visible through structure, front-month premiums, curve shape, options bid, dealers quoting smaller size, physical premiums refusing to cool. What makes the withdrawal scenario especially potent is contagion. The moment one anchor steps back, every other participant asks a survival question. Do I want to be the last one providing liquidity into a one-way market? That's not conspiracy, that's self-preservation. It's the same behavior you see in every stress episode. Late 2008, March 2020, and smaller commodity squeezes where the physical side tightens while paper still looks deep, until it doesn't. And because silver is smaller than many macro markets, flows matter more. A few large allocations can move it. A few desks stepping back can change its character from liquid asset to gappy instrument overnight. Now layer in month-end dynamics. Balance sheets are measured, reported, defended. Exposures that were tolerated mid-month become politically and procedurally painful at month-end. Risk committees become conservative at the same time, not because they coordinate, but because they read the same environment. This produces synchronized caution, and synchronized caution is what turns normal markets brittle. So if you want a simple framing, month-end is when markets stop believing in the smooth version of themselves and start checking the fine print. And in silver, the fine print is settlement credibility. If enough players start treating delivery preference as a real scenario rather than a theoretical tail risk, the paper market can remain active while the physical market becomes tight. And that divergence is where repricing becomes violent. Not guaranteed, but plausible. And in markets, plausible outcomes are what options get priced for and what risk managers react to first. Now let S talk about the phrase that scares leveraged traders more than any headline: impossible math. Impossible math is when exposure sizes and settlement constraints can't be reconciled smoothly under a deadline. That doesn't mean the world runs out of silver. It means there isn't enough readily mobilizable supply at the margin to satisfy urgent demand without price moving dramatically. And price is the rationing mechanism. When supply is sticky and demand becomes urgent, price doesn't rise politely. It jumps until behavior changes. If buyers are time-boxed, they buy anyway. If sellers are patient, they hold anyway. That yes, when the market does the only thing it can, it reprices to a level that shakes out supply or forces cash settlements or triggers substitution. In a forced adjustment phase, the market becomes less about fair value and more about clearing price. Clearing price is the price that makes enough people do something they didn't eat tea want to do yesterday: sell metal, redeem ETF shares, switch to alternatives, reduce industrial usage, delay procurement, find scrap flows. Price doesn't need to be reasonable, it needs to clear. This is why late-stage commodities overshoot. Market participants expect a rational top. They rarely get one. What they get is a climax where headlines sound insane precisely because the market is clearing a structural bottleneck, and bottlenecks don't clear at comfortable prices. Now tie that back to silver's dual identity. It is an industrial input and a monetary hedge. This creates demand that doesn't disappear when the narrative changes. Solar procurement doesn't pause because a chart looks stretched. Electronics demand doesn't vanish because an RSI is high. Meanwhile, investment demand can surge precisely when trust in financial plumbing weakens. So silver can see demand from two different clocks at once: the slow industrial clock and the fast financial clock. When those clocks overlap during a stress window, the move can feel sudden because the physical side can't scale instantly. Mines don't ramp up on command. Silver is often a byproduct, so even high prices don't guarantee immediate supply increases. That lag is the quiet monster behind every shortage story. And here is the behavioral kicker. Most traders don't lose by being wrong on direction. They lose by being wrong on liquidity. They assume they can exit when they want. They assume the market will give them a price between ticks. They assume stops will work cleanly. But in brittle markets, stops become market orders into air pockets, slippage expands, and the exit becomes the loss. And if you're short in that moment, losses are not linear. They accelerate because buying to cover is the exact action that makes the market rise faster. That's the squeeze loop. And squeezes feed on certainty. The more certain the short is that this must correct, the more leverage they use. And leverage is exactly what margin calls eat first. So the real question is not, will silver hit a number? The real question is, are we entering a regime where liquidation and forced covering can happen faster than liquidity can absorb it? If yes, the market can leap multiple levels in a short period without waiting for consensus to catch up. So how do you watch for confirmation without falling for hype? You watch the tells that professionals watch because they're harder to fake. First, the curve. Look at near-dated versus later-dated pricing. If the market starts paying for immediacy, that's a sign of preference under pressure. Second, physical premiums across multiple regions. If spot is calm but premiums stay stubborn or climb, physical is speaking a different language than paper. Third, financing and lease behavior. If holding metal becomes relatively more expensive or sourcing metal becomes relatively harder, the plumbing is tightening. Fourth, depth and spreads. When quotes widen and size shrinks, the market is signaling reduced willingness to intermediate. Fifth, options. If implied volatility firms while realized volatility is still contained, participants are paying for tails, which often happens before the move, not after. Sixth, absorption behavior. Sharp dips that get bought instantly, especially during normally quiet hours, are a signature of larger flow treating weakness as inventory opportunity rather than profit-taking moment. Now, here's a subtle point that matters. In tightening regimes, news becomes less important than constraints. A small catalyst can produce a big move because the table is already tilted. That's why month-end can feel like nothing happened, until suddenly something happens and everyone pretends they saw it coming. A minor policy comment, a modest data surprise, a routine margin tweak, a funding hiccup, an ETF flow spike. None of these needs to be dramatic. The drama comes from the structure under them. If the structure is brittle, small triggers are enough to force repositioning. And repositioning in silver can be dramatic because it's a smaller market relative to global capital, and because many participants approach it with leverage. Now also expect a psychological war as the move develops. You'll see confident calls for a pullback, perfect entries, dead cat bounces, and bubble narratives early. These narratives are not always wrong, but they often arrive as coping mechanisms because humans hate buying higher and hate holding through volatility. The uncomfortable truth is that late-stage moves often look ugliest right before they accelerate because that ES when disbelief is still common. If everyone believed, positioning would already be crowded and the market would be stable. The biggest moves begin when the crowd is still arguing whether the move is real. And that's why any talk of tomorrow in silver should be handled carefully. You can't promise timing. What you can do is explain vulnerability windows, month-end balance sheet stress, high correlation environments, financing selectivity, and reduced liquidity provision. If those overlap, you don't need prophecy, you just need to respect the possibility of outsized movement. Let's bring it home with a clean framework, not a hype pitch. Framework. If a major liquidity provider steps back near a reporting window, you should expect two things even without any crisis. One, more discontinuous price action, meaning gaps and sharper swings because fewer intermediaries are smoothing flow. Two, a higher chance of paper physical divergence lasting longer, meaning premiums can persist and arbitrage can fail to fully close the gap because financing and logistics don't cooperate at scale. In that world, silver becomes less like a normal commodity chart and more like a stress sensor for the broader system, especially when collateral is being reused aggressively and margin sensitivity increases across asset classes. When correlations spike, risk managers act first, not last. They cut exposure where they can, not where they should. And because silver is liquid enough to trade but small enough to move, flows can hit it in a way that surprises people who only watch equities or FX, that guess why you don't want to anchor on one narrative like banks can T deliver or silver to X by tomorrow. Those phrases are emotionally satisfying but analytically fragile. Instead, anchor on mechanics, curve behavior, financing friction, physical premiums, depth, options pricing, and the speed of absorption on dips. If those indicators tighten together, you're in a regime where outcomes widen, where fat tails become relevant, and where the market can reprice faster than commentary can adjust. And if those indicators relax together, pressure is easing, and the market can consolidate without drama. The point is not to be theatrical. The point is to be prepared mentally for behavior that doesn't feel orderly. Silver bull phases don't end neatly. They end with volatility that punishes impatience and rewards discipline, but only if you understand that the hardest part isn't buying. It is holding through the phase where every instinct tells you the move is too far. If the withdrawal scenario proves false, good, you still learned how to read the market beyond the candle. If it proves partially true, you'll have already been watching the right signals instead of getting whiplashed by headlines. Either way, the actionable edge is the same. Stop relying on comfort narratives and start reading structure, because structure is where the market tells the truth before it speaks loudly. And that's the real message going into month end. The surface can look calm while the plumbing tightens, and when the plumbing tightens in silver, the release is rarely gentle.